A currency collapse is coming, and it will cause widespread panic. I'm your host, Steven Van Metre, and thanks for joining me today. And yesterday we talked about how China's economy is collapsing. Today, it's the Japanese yen, and that's going to cause major panic in the global market. Let's head over. We picked this story up as Japan once celebrated a cheap yen. Now, the worst currency crash in 20 years is causing widespread panic. The Japanese yen dropped to a 20-year low against the US dollar that risked being bad news far beyond Tokyo in the 23 trillion market for treasuries. Well, we'll look at that in a moment as traders around the world watch the yen's rise and fall, not just to follow Japanese markets, but also gauge how investors globally are feeling. Usually when markets are rallying, the yen tends to weaken against other currencies. And when market gets turbulent, the yen tends to gain ground. And that's one of the key points here is that yen is considered a safe haven. But right now we're seeing global equity markets decline, and the yen is too, and that is a big problem. The yen has fallen 12% against the dollar in 2022, even as the Russia-Ukraine war sent global stocks sliding. Its fall has been so steep that it ranks as the worst performing currency this year out of 41 tracked by the Wall Street Journal, worse than the Russian ruble or Turkish lira, if you can imagine that. If the yen were a smaller currency, its slide might have less importance to financial markets, but the yen is key to global finance, ranking as the third most traded currency in the world. And so when we talk about the dollar as a global reserve currency, it is the primary currency used for global trade. This puts the yen at number 3, and so you can see just how important it is. So when it is collapsing in price, that's bad news, because in global trade, you want price stability of your currency or the world will lose confidence in it. The Federal Reserve is poised to begin winding down its extensive bond buying program as early as next month. The central bank counting on investors like Japanese institution, the biggest foreign buyers of U.S. treasuries, to step in and help absorb the increased supply of treasuries on the market. Now, this is a big story, a big question that people have, and we're going to dig into this a bit, is what is going on with Japan and their purchase of treasuries. Are they the ones that are dumping treasuries, or is it just retail investors fleeing the bond market because rates have gone up and they tend to sell when things are low and buy when they're high? We don't know, but we do have some data, and we're about to get some more. So let's take a look at the official government data, because so far from all my sources, if Japan is selling them, I have no evidence that they are, but I also have no evidence that they aren't. But here is the data from the U.S. government showing Japan the largest holder of U.S. treasuries. This data is as of February. It is the most current. We should be getting March's pretty soon. And they currently hold $1.306 trillion worth of treasuries. And you can see that is not quite their all-time high at $1.310 trillion. Or, well, there it is, 1.328. I guess I was looking too far to the right. But you can see they're still holding a decent amount. And even though they declined a bit since November, it's not a massive amount of selling. But the yen's rout might cut into Japanese demand for treasuries. That is because as the yen weakens, Japanese investors with dollar-denominated assets will have to pay more to hedge against the risk of currency fluctuations cutting into the returns. In theory, relatively generous U.S. yields should make treasuries still attractive to Japanese investors. In fact, that's a case that I've made, that with U.S. yields so high relative to other currencies, when you have a choice of where you're going to park your money, you have the world's safest, most reliable government and economy where you can park your money in a risk-free rate, or you can take your bet somewhere else. And that's why I believe that the reversal in U.S. Treasury yields may be already upon us. But some think it's all up to Japan now, as hedging has gotten so expensive that the extra yield as a Japanese investor would get from holding treasuries instead of Japanese government bonds, believe it or not, has almost disappeared. As Japanese investors who decide to stay in the treasury markets might bypass higher hedging costs by foregoing taking out protection against currency fluctuations. But that carries its own risk. If the yen were to abruptly rally against the dollar, your yield advantage could completely erode in a few days. And traders betting on sustained yen weakness were burned by a rapid and violent unwind to that bet during the Asia financial crisis in 1998, as well as a great financial crisis in 2008. And now you start to get a snippet of why this could cause widespread panic, because if the yen were to rally, well, some people are going to be caught off guard. Now, you might be wondering, Who would be so bold to wildly short the yen? Well, I think you might have a hunch. If you said hedge funds, well, you're right. Hedge funds are still betting heavily on the yen falling further, with net positions against the yen recently hitting their highest in more than 3 years, according to recent data from the CFTC. And here you can see in a chart that I did not bother to put any marks on because I wanted you to see the weekly net positions of hedge funds in the yen. This is thousands of contracts, as you can see back here in 2020 or 2019. It was very deep, but now look, in 2021 and now 2022, when in doubt, who's betting against something? Well, it's probably a hedge fund. And if that were to blow up and they were to have to start to unwind those positions, well, you could see in the past, it's called and caused some things called a crisis. And if there's one thing that shouldn't have a crisis, that's your portfolio if the global economy blows up. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and in the description below. You'll be glad you did. So why is this unwinding? Well, in a rare moment, one of the newspapers, this case the Wall Street Journal, got it right. So why is the Japanese yen falling so much as traders say increasingly divergent central bank policy that I mentioned yesterday has driven the currency slide this year? So yesterday we talked about this in relation to China. Now it's Japan, as the Fed raised interest rates in March for the first time since 2018 and signaled it could raise rates 6 more times by year end as part of an effort to fight a sharp rise of inflation. But the Bank of Japan has remained staunchly committed to keeping interest rates near zero, as a widening gap between rates in Japan and other countries has pushed investors to dump yen-denominated Japanese assets, pick up dollar-denominated assets. Again, as I mentioned yesterday, people flight to safety of U.S. assets, which stand to offer higher yields. That has sent the yen to levels few anticipated at the start of the year. And again, this becomes a story of the Fed is raising rates and everyone else doesn't really want to. Some of them do, but Japan, as much like China, doesn't want to. And that causes a problem because if they don't raise rates and tighten monetary policy, they risk creating inflation and some other really bad things. Here we can see the Japanese yen could weaken to 135 per dollar in the very near future, according to Wells Fargo. The Japanese yen may continue to see weakness against the U.S. dollar if the policies of the Bank of Japan and Federal Reserve continue to diverge. And assuming the BOJ policymakers stay committed to the easy monetary policy framework, we think a move towards maybe 135 yen per dollar could be likely in the near future. And this has major implications on the global economy. And we'll show you just in a moment what that means to the U.S. Because the Japanese currency has struggled for gains against the dollar amid expectations the Bank of Japan will lag its peers, such as the U.S. Federal Reserve, which is expected to raise rates by 50 basis points next week. And what does that mean for the U.S. data? Well, we just got the durable goods new orders. Durable goods, think washers, dryers, fridges, things that you buy and keep for a while because they tend not to break, and hence the term durable. Month over month, we saw a big increase of 0.8% in core, which excludes food and energy, rose 1.1%. So this would show you that there's strength in the U.S. economy. But what does that mean if the dollar continues to rise? Well, nothing good. And so here you can see the manufacturers' new orders durable goods in blue on a year-over-year rate of change against the nominal broad U.S. dollar index. So what happens when the dollar starts to rise? Or in this case, if the yen continues to fall against the dollar, you can see the year-over-year rate of change in manufacturers' durable goods declines. Here you can see a rally in the dollar leads to a slowdown in manufacturers' new orders durable goods. And here you can see a rally in the dollar and slowdown and eventual contraction going into the pandemic. And now we're continuing to see an increase in the dollar and a slowdown of U.S. new orders in the durable goods. And again, that comes back to the U.S. economy. So a strong dollar actually helps stifle exports. And when that happens, the growth engine of the U.S. economy, all that employment that everyone's been excited about, starts to go away as new orders come down and manufacturers start to lay off. And that is a bad problem for the dollar. And of course, with the Fed continue to tighten monetary policy, it means the dollar is going even higher. And that is bad news for the yen and other currencies, especially if they don't tighten. And a free fall in yen is a soaring global risk. A sudden 12% plummet of Japan's currency could reverberate far and wide beyond Japanese shores, as we see first few events wreck a hedge fund's year faster than the sudden about face in the yen. So if we look at the two keys from today's show, from late 1990s, early 2000, the 2008 to 2009 global crisis, there are a myriad of well-documented examples of sharp yen moves devastating markets. And now, as you've seen, of course, a lot of hedge funds are deeply short the yen, suggesting that any kind of reversal, that could be due to policy changes, could be the Bank of Japan tightening, could unwind and blow those hedge funds directly apart. But that's not the only risk. And second, there's something quietly terrifying about the developed world's most indebted nation, that being Japan, being unable to hold its own financially speaking, and that perhaps could be the first country where we see uses monetary policy to literally detonate its economy. And so now you know that why there could be widespread panic if the dollar continues to rally and the yen continues to weaken. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.